All right, folks, welcome back. This is our review and final discussion in the free 2022 ICT mentorship for YouTube. So this is June 23rd, 2022, and we're looking at the E-mini S&P September contract for 2022. And this is an hourly chart, so I'm cutting right to the chase here. And this morning on Twitter, I was looking at, well, I was expecting actually a little bit more volatility around the Fed Chair Powell speaking at 10 o'clock in the morning. And we didn't get a whole lot of excitement, but we did get to see ICT's expectation fall short. So that's one of the benefits of seeing it live with me. An expectation, an analysis, a call, a viewpoint, a perspective, opinion, not coming to pass. Okay. And time of day, how I used it, and how you should use it going forward, and also how it kept me from looking at an incorrect setup that would otherwise maybe a catalyst for you having had a incorrect setup this morning. And I'll talk about that in a moment. But for now, this is the framework for today. We had sell side liquidity here. The market dropped down, took that sell side out, rallied up. Buy side here. I was looking for 38.05 level today, and this is the reason why. And I was looking at it early on in the morning. I wanted to see it run up here and hit that. If it was going to hit it, I would have been watching for a potential short to form, but it didn't do it. So that was my expectation based on this high back here. We already took sell side, so I was looking for a little bit deeper run into this high here. When we just went just above that short-term high there, gave up the ghost and went lower. And I had a trade that got stopped out plus 2 points. And I'll talk about that when we get into the lower time frame. All right, so here is the 15-minute time frame. And usually I have the charts blank, and I'll ask you to take a look at it. I don't want to do that tonight because I want to get to the teachings at the end to kind of like bring this entire mentorship to a close. The teachings itself will end for this model in this lesson. Okay, so technically there's 41 videos that make up this mentorship. So if you take away the introductory video, it's basically what, 40 even? So that's not bad. Hopefully you found it insightful and helpful. But looking at this morning, we had the 10 o'clock Powell event here. And the market started to run up, and we took out the buy side here. But again, I was aiming for this. This is what I wanted to see. I want to see it run up here. And I actually took a long in here. I was wanting to see it run up into that level, and I was going to do a reversal, and it didn't obviously give it to me. So notice the time of day here. This is the New York Index AM session, operating hours, or kill zone if you want to call it that. And it's 8:30 in the morning to 11. Now, I can take trades after 11 o'clock, but I want to kind of like stick to the rules and present you opportunities to see where following the rules, you're going to miss certain opportunities. It's okay. It's fine. You're going to get it wrong sometimes. You watched me get something wrong today. There was no skin off my back. Nothing, bad happened. Just I didn't get what I was looking for. And because it was late in the day, as we'll look at the lower time frame in a moment, but it ran above the short-term buy side liquidity here. I wanted it to run up to here, but it broke down. And I was telling myself, and also made my views public on Twitter, that I wasn't interested, and I wasn't quite sure what it wanted to do because it was approaching that noon hour. And I took a trade, and I was out +2. So in other words, I was just covering expenses basically. And I was wrong on the initial run. So when I have that scenario and it's off of a Fed chair or a high impact news event and it didn't pan out like I was expecting it to, in my experience, it's been better for me to just move away and say, okay, I'm going to close the computer and I'll come back later on and see what's going on. And I didn't want to trade any more of the morning session leading into noon. So I had waited, and I was going to take a look at what it did in lunch hour and then post lunch hour around 1:30 and see what there was opportunity to do anything then. But we have a fair value gap on the 15-minute time frame here. See that? So the market eventually, after running the buy side here, drew all the way down, took out sell side here, overrun this fair value gap here. Why did it do that? Because this is a larger one. So if it's going to go over top of this one and trade to the top of this candle, which is the low end of that fair value gap that's here, that's not noted on showing you by the respective candles. If it's going to go here, that's also the high end of the fair value gap here. So it's likely to go over top of this one and run into this one. Okay, and it does that as we're going into the noon lunch hour in New York until 1 o'clock, where it makes the low of the session after closing in the fair value gap, and then the 1:30 to 4 New York local time, that's the PM session, New York index PM session, or afternoon session for index trading. And the market started to create a willingness to want to go higher. We'll look at a short-term shift in market structure when we get in the lower time frame. But it draws all the way back up to the target I was looking for in the morning. So the expectation of going to that specific level, let me explain to you what I was looking for. I wanted it to go above, hit that, and then sell off and go down to this area here for a discount, and then create the run and then go beyond 38.05. That's what I was really looking for today. That's what I wanted to do, but it failed to get to 38.05. It fell down into this area here, and I knew once it broke here, I don't want to go short because I'm going into lunch hour, and I was concerned it was going to consolidate a lot and then take forever to get down into, and I don't want to hold anything new into lunch. So I'd prefer to see some kind of a stop run in the lunch hour, which is what we're seeing here. It runs down below that and into a fair value gap, deep discount between the low, high, trades down into it, and then rallies up. This session here, we'll look at it on the 5-minute chart. So we can see, obviously, the initial poke above here. Inside this area, I was looking at a 2-minute fair value gap. I mentioned that on Twitter as it was forming, and it rallied up. And then once it took the short-term high out, when this was a bold-faced bullish candle, I was thinking to myself, okay, it could expand up in here, and I'm watching that. And I had a tweet ready to go. I'm going to sell short here and look for a run down into this level here. Never got it. Okay. And then some of you probably going to hear this and say, oh yeah, sure you did. I mean, it is what it is, folks. I mean, I was out there without a safety net, and I told everyone what I was expecting, what I was looking for. It just simply didn't pan out, and that's okay. But the market eventually breaks lower. Then after we get into the lunch hour, closing at 1 o'clock, and then I personally like to wait till 1:30 because it's a little bit more cleaner price action. The market starts to rally away, drops back down into an order block, a fair value gap on a 5-minute chart. Then we have a shift in market structure here on the 5-minute chart. Creates a small little return to a fair value gap there, rallies, another fair value gap, it runs into it here, rallies, and eventually takes out the short-term high of the day, and then runs to the level I was drawing your attention to on Twitter. All right, so here's the 5-minute chart zoomed in with the morning session. You see the run here on the buy side, one more here, and eventually breaking down. Displacement, small little fair value gap here, rolls down into the fair value gap here, and then once again, returning back up into an imbalance, then runs down to the low end of the fair value gap, turning basically at the low of the session at the low end of the fair value gap at 1 o'clock. So closure of lunch time hour, it creates that low. This right here is the 2-minute chart. And this is the fair value gap I drew your attention to live. And it came down into it here. And inside this fair value gap, I was basically drawing your attention to that as a potential long I did. And I was looking for a run into 38.05. And it started the run, took out the buy side here. I mentioned the buy side would likely be a draw on liquidity. It was, but I wanted to see it draw up to here. That's the specific level I was looking for. And the market comes back down into the fair value gap again once more, and then rallies above the short-term high here. This right here would have been a nice opportunity for me to basically say, pay the trader, and me take something after I tweeted that off. But I didn't, because I wanted this level here. Okay. Now one could argue and say, oh, you're being greedy, or you didn't follow rules, or you didn't do this and you didn't do that. And it's easy to armchair quarterback someone. And it's okay if you want to do that in the comment section, that's fine. But just know that I'm doing this real time. And I'm okay with being wrong. Wrong isn't going to ruin me. I'm not 100%, but I'm generally on par, better than the average bear. Okay, we'll just say it that way without sounding like I'm bragging. But once it came back down in, it stopped me out because I rolled my stop up to a level that I wasn't willing to weather a deeper retracement, because this is the takeaway. Fair value gap. We trade down into it. We get movement. That's good. Comes back down in again. Complete closure of the fair value gap. Okay, that's acceptable. Does it start to rally away? Yes. That's why I felt confident that it was going to go up to here. Because if it was going to go above here, then it should just spread its wings and run to that 38.05 level with no problem. It wasn't having it. The market dropped back down and didn't quite take out this short-term low with any displacement. So while this fair value gap exists, it's not one that I would have taken, because we didn't see a displacement with meaningful movement below that low. So this is not a fair value gap that I would have been a participant in. So looking at that, I'm thinking I'm not interested. I'm going to close up shop, and there it is, because I didn't get this run below here. Now, had I seen that, I may have, I'm not going to go out on a limb and say absolutely, but I may have, if it would have shown like this type of movement on this candle below that low, and then we moved back up into this right here, then I probably would have said, well, I'm going to go short and aim for this low here. And then at noon, if I didn't get here, I would just close it off and then ride out the lunch hour. So that was kind of like what was going on in my head. Because it was an event around Powell, I didn't want to give you guys a lot of things to be concerned about or get lost in the commentary. And plus, I didn't want to be worrying about someone doing something, hurting themselves. I knew invariably some of you are waiting there with a live account ready to click a button because I've said something. Okay, so that weighs heavily on me when I comment on Twitter. So I just want you to be careful, okay? Do it in a demo, don't do it in a live account. But we had another fair value gap in here. Trades up into that nice closure perfectly, and runs down to the top of the fair value gap on that 15-minute time frame. One more little bounce in, then rolls over and goes deeper into the fair value gap. All right, here is the afternoon session, and this is where we're going to be doing the bulk of the discussion on the remaining portion of this video. And I'll frame the logic around risk management and stop loss management, and that'll complete the model. The rules I'm going to give you are static. They're always the same, so that way you know once you put a position on your demo account, where is your stop, how much are you risking, when do you move your stop. Okay, and this is the rule that I use. And sometimes you've seen me show trades where I get in and I'm not really trying to move my stop loss. I'm taking partials along the way, but I'm not really trying to rush my stop loss up. I'm going to show you the rules I follow so that way it makes sense to you. And it'll help you also trust taking partials, letting that become a better way of managing a position and trade, and not be fearful about being stopped out, because the stop loss is there to do its job. You pay it well to do that. But if you're worrying about that stop loss being tripped versus following along in price action and continuously measuring whether or not price is giving you what you're expecting in terms of bullishness or bearishness, is the institutional order flow still bullish if you're long, or is it still bearish when you're short? those types of things are more important than worrying about whether you're going to get stopped out or not. That's not to minimize, obviously, the risk that's respected. Obviously, you should be respecting the risk by actually putting a hard stop in. But if you don't put a hard stop in, you're not really respecting the risk. What you're saying is I'm risking this trade because I believe I'm right. But if I'm wrong, I'll figure out where I'm wrong when it gets there. You don't want to do that. Okay, so anyway, we'll close that portion of the discussion at the end of the video. But here, it's a 2-minute chart showing the afternoon or PM session for index futures. And you can see we traded down into, this is showing a weird time because it's 2 minutes, but this is the 1 o'clock hour. It hits the low and then starts to rally up. Short-term shift in market structure here. Key time of day, 1:30. It trades back down into an order block, last down close candle. There is a fair value gap right here. I didn't note it because it's going to be too cluttered up, and I'm going to be basically doing a lot of discussion in this area, and I don't want it to be overlapped with too many things to be navigating. So this is the 15-minute fair value gap, and it's trading down to an order block after a shift in market structure, after trading down and closing in a 15-minute time frame, fair value gap, and then it trades into an optimal trade entry, which is the flagship pattern of this YouTube channel. Fair value gap with an order block and optimal trade entry is the gold standard of the ICT pattern that's taught on this YouTube channel. This is where you can be long and expect price to reach for here and here. Okay, so we have objectives in here where we can look for this imbalance here, buy side liquidity here, buy side liquidity here, and we'll watch and see, does it continuously march higher? So we have a run from here to the short-term high. Then we have this fair value gap here that runs here up into the 30.05 level. So this PM session I was long in, and I'm not going to try to build the case to outline everything because I want to give you what's salient to close this mentorship and show you how to use the stop placement, risk management, and give you a working example. I know some of you like to see, did I really take a trade? Yeah, I was trading today. So you can see here, a live account and $1,975. Okay. Back to the lesson, and you'll see what it means to go through the process of determining risk management and stop loss placement and when you move your stop. All right, so we're zoomed in here and looking at the 5-minute chart. And again, that's the fair value gap we're going to be using here to frame it. So if you're looking at the idea of you traded down into that fair value gap, does it show willingness to go higher? Yes. Is there a short-term shift in market structure? Yes. Is there a gap? Yes. Down close candle to the left of it? Yes. Drops down in, bullish order block, optimal trade entry. In other words, that would be a 62 to 79% retracement level, less than equilibrium relative to the high and the low, respectively. So we would be looking for a limit order to be at 37.5475. We'll use that. Okay, so 1/4 point less than this candle's low. So that would be our hypothetical limit order to buy going long. And we have to use the low here for our stop loss. So 37.45.75. Essentially 9 points of risk. Okay, so we'll come back to that in a couple minutes. But for now, what we'll be reaching for, what will be the draw on liquidity from this high down to that low, we want to get to a premium level. 50% is about right in here, eyeballing it. We don't need to have a fib on that. You should do it for yourself. But then we have this imbalance here. So the first low-hanging fruit objective would be this candle's high. That's 37.80 1/4. So we're looking at about 25.5 handles of potential points profit per contract. So we're risking 9 points to make 25.5. Not bad. It's better than 2.5 R. So you're going to risk $1 to make $2.50 basically. And that's on a run from here to here. We don't need to know if it's going to go up to here yet. Okay. This right here is one trade from here to here. Then it creates another opportunity in here where it can run from here to here. And we'll talk about that when it gets into the discussion on risk management and trade management. All right, so risk management. Anytime you're trying to consider what lot size or how much you're supposed to be trading or whatever, there are free tools if you Google them. Okay, it's amazing how many folks ask me and other educators out there the most simplest questions that are answered just by a Google search. Okay, I know it feels easier. I think it's a matter of just getting a personal response from the educator or whoever it is that you're asking. And it's not possible for me to go through every single person's question and reply to them. So hopefully you understand that there's just simply no way for me to do that. I don't have enough time in the day to do that. Nobody really does. But simple things like lot size calculators. Okay, you can do a Google search on that. And there are some wonderful free applications and tools that will make that known to you by you just plugging in how much money you have in your account, what risk percentage are you trying to use, what size stop loss are you going to use, and it'll tell you how much leverage, if you're trading Forex, or what your lot size should be for futures. Now, I understand that's probably not the response that you're wanting because you want to have an interactive experience with your educator or mentor. But these are really basic types of things that could be learned and understood and found the solution to by simply doing a little bit of the legwork yourself. With that said, I'm going to give you one example here and just kind of like walk it out for you. Assuming you had $10,000 and you're trading index futures and you are using this trade idea that I'm outlining here that I was monitoring in the afternoon session. $10,000 is your equity. You want to take 1% risk per trade. So you're going to take that $10,000 times it by 0.01. That's going to give you a figure of 100. That's $100. That's what 1% of $10,000 is. That means that's the total amount of risk that you're willing to assume. We determined from the hypothetical entry of your demo account at 37.54 3/4 and a stop at 37.45 3/4. That's 9 points or 9 handles. Okay, that's what that 9 is. So we're taking the dollar amount, which is the 1% of our equity, giving us $100 or 1% of $10,000. Total movement that we're willing to absorb as a risk or a stop loss is 9 points. So we take 9, divide that into 100. That gives us 11. Okay, 11 times we can get the figure 9. That 11, if we're going to trade a mini or E-mini futures contract on the S&P, the multiplier per contract is $50. So divide 50 into 11. You can't. So you right away you know you can't trade a mini if you're going to be risking 1%. So you have to drop down into the micros. So now we have 11 with the multiple of 5. So a micro lot on E-mini micro, instead of $50 per point, it's $5 per point. So how many 5s can you go into 11 with it? 2. So you can do 2 micro lots. Now, this might not be for you because when I do risk management, I don't really factor in commissions. I'll just do the math like this. So you might look at that and say, well, what about commissions? That might not allow me to do 1%. If you're going to be very hardline about the risk management, and I get it, some of you should be like that in the beginning. But as you get more experience, you'll start thinking, oh, well, the covered costs of commissions and such, over time, that's fine. I'll work that out. But for risk management, just for the entry to stop loss, not factoring commission costs and fees with your broker or spread, okay, all those ideas need to be considered. But we're going to assume that they're not going to be considered for this example. You have to figure that out on your own if that's how you're going to do your risk management. But for me, I don't ever factor in the costs, because costs are always going to be, they're like taxes. You can't avoid them. So just, you eat it, okay? So you can do 2 micro lots at $5 per point, making profit or taking in drawdown or loss per point fluctuation. So if we're buying at 37.54 in 3/4 and we're risking 9 points, how much money is that? $90 risk. So we're under 1%. So we're not even risking a full 1%. Our target is 25.5 points, or $255, because 2 micro at $5 at the multiplier of each point. 2 times 5 is 10. So you're making $10 per point because you're holding 2 micros. So 25.5 points here at $10 total multiplier based on the 2 micro lots, which would be basically 2.25% return. So you're going to risk 1% to make 2.25% on one intraday scalp here. And then you have another one here. And if you were trying to do shorts over here, you could have done something equivalent to that as well. So it's not hard to make 1 to 3 to 5% in one day with intraday price swings. The problem is you're going to get overexcited and think that you can do every single fluctuation in price action. And these types of movements, while they're exciting when you do the math on them and you see the potential, a lot of times people will say, well, 1%, I can't make money with 1%. Man, you can make a lot of money with 1%. Okay. If you can make 1% a day, that's enormous, because that compounds over time. And it's not a matter of saying, well, if I make 1% a day and I do that Monday through Friday, that means I made 5% at the end of the week, or 20% for the month. Correct? That's what most of you are probably thinking right now. When in fact, you're actually able to get 22% a month because of the effects of compounding. If you do 1% per day, trading Monday through Friday, 4 weeks average per month, one could make 22% a month. Now, 22% a month is phenomenal. Like, that's ridiculous rates of return. Professional money managers and fund managers don't try to do that for a whole year. Some of them do anywhere between 12 to 15% a year, and they call that a stellar year. And if they make 20% or more, that's a blockbuster year. And they're parade around in front of their clients, they see that type of return and bolster their confidence to put more money in. That's usually when they'll say, hey, you want to allocate more money, because they get paid to do that. Well, 1% is, in my opinion, obviously, it's not going to be the case for a new student or a new trader, but in my opinion, 1% every single day is unrealistic. But for a seasoned trader, 1% average per day is really easy. But you're going to have to get the experience to do that. And again, that also equates to the average of 1%. So in other words, if I have one trade a week and I make 5%, that's equivalent to 1% a day for the week. I'm not going to sit in front of the charts to try to make 1% each day. It's not reasonable for me. I have things I have to take care of. I have businesses to run and family to tend to. And I can find setups that I can frame and make 5% on one setup, or first partial of a trade. So it's a matter of how you're going to form fit this for yourself. Okay. And obviously the best scenario would be, if you're going to be eventually getting to the point where you can risk 2%, you can do this framework for one limit order to be buying at 37.54 3/4, use the stop as explained here, and do a second order the same way, but don't use this as your profit objective. Use this short-term high here, or the target I was outlining, 38.05 and a half. And then you would be able to get a run from here to here on one that would close out. And then the second one would hopefully run up in here and get the daily range. And you can do obviously better than 2.25%. Just on this one, you'd have 2.25 twice, because the one that you bought the one you bought here that got out here That's your banked 2.25% hypothetically. Then the second one would be running here and then rolling through that level up to here. So you could be making as much as 4.5% more on the second position. So what are you really making? 6.75%. One day, 2 orders, 1 trade. And a lot of you guys are trying to do those funded account challenges, and they give you like, you got to make 10% to do this and that. If you learn how to trade and you learn what I'm teaching you, folks, listen, those numbers are achievable, but you have to know what you're doing. And also how to weather drawdown. Drawdown would be having your account reduced from either its starting balance, or after you've made equity increases, you start taking losses. That's drawdown. Well, that drawdown has to be managed. So if you have a trade, and for instance, say you took this hypothetical trade here with 1 order, and you got in at that 37.54 3/4, and you got stopped out down here. Okay, you would have taken less than 1% loss. So your next trade, you should do half of 1%. Why? Because number one, you have emotions, psychological impact of taking a loss. You're going to be most likely wanting to have revenge, and you're probably going to want to do more leverage than you should, and you're probably going to want to get it faster than you should. In other words, being patient is not going to be the right thing for you. You're going to feel like impatience is eating at you, so therefore you're going to have to hurry up and get right back in there and try to get your money back. And that is a loser's cycle, gambler's mentality. So by reducing the risk on your next trade, once you take a loss, then you have to make back 50% of what you lost. So in this case, if you would have got stopped down here, we'll just round it to $100 with commission. You have to make $50 back before you can go back to your full 1% risk. And it's easy. That's easy to do. It's not easy to follow this logic. So what happens if you take that second trade and risking a half of 1%, and that trade gets knocked out to a loss? What size do you use on your next trade? 1/4 of 1%. And that's obviously the lowest you can go with. So you have to determine what your risk is, and it's going to obviously reduce the number of trades you can take. That's why I tell everyone, there's a lot of you out here that are starting on a shoestring, meaning you don't have a lot of money, and you're trying to speculate with live funds with a $50 account or a $100 account. And I get it. I understand. It's hard if you don't come from money, if you don't have the resources where you are globally. It feels like you're out of reach. Learn the skill set. Okay? I promise you, if you learn the skill set, you can do funded account type things as a venture, or find partners that'll come in with you. You don't need the money. It doesn't have to be your money. You can make a lot of money with other people's money. But funded accounts provide a way for you to go in with a very small amount of money, and you learn the skill set I'm laying down here in public. You can walk right into any one of these funded account challenges, okay, if they want to call it a challenge, and just walk right through it and take it over, and then secure whatever size account you're trying to go for, and then trade it soberly. Aim for 10% a month, 15% a month, and just make that and stop. Don't try to push it. Don't try to get rich real quick. You want that 10 to 15% a month coming into your hands after the split that you do with whatever that account is, registered with, whatever funded account company that's helping you find the scratch to get started. But knowing how to manage that drawdown will keep you from going into, obviously, blowing your account. It'll control the equity drawdown. It won't be a sharp, jagged falling off a cliff. It'll be, you run up to new equity highs, and you have a losing trade, which is reasonable. Everybody has a losing trade. You may have a series of losing trades. But if you take a 1% loss, and then you take another loss at half of 1%, and you take another loss at 1/4 of 1%, you're only down 1 3/4%. That's not a lot of drawdown. But you've now taken 3 losing consecutive trades. That's easy to come back from, versus taking 1% loss, then saying, okay, I'm going to double up and try to make it back with 2% risk, because I don't have to just get half of the position movement I took as a loss. And then you take a full 2% loss. Now you're down 3% on 2 trades. Then you go in again thinking, well, I'm going to do it again with 2%, or worse, you go higher, risking 3% or 4%. And then you use a stop, or you move your stop, opening it up with more risk. And then suddenly it's very easy to fall into 10% drawdown. And then it becomes a psychological wrestling match where now you feel embarrassed, you're shamed, you feel like you have to have it back, otherwise you're a failure. When professional money managers, they don't care about being in drawdown. They care about managing their expectations and the discipline that's required to operate and engage. They are not allowed to touch their account when they're highly charged or emotional. So that's all part of risk management. It's not just the numbers game. It's a psychological game too. But you have to manage that and quell that whole desire to get right back to where you were before you took that loss. That feeling comes because you are an infant in this industry. And that's not a knock against you, okay? It's the truth. If you were working with me one-on-one and I was standing in the same room with you, I would say it to your face. You're an infant if you think like that. It's infantile to think that way. It's not a rude comment. It's the facts. Because you want to get your toy that was taken from you back right away. And you don't need it back right away. When you have a loss, or if you go through drawdown, a professional money manager views it as it's a loan that you're going to collect interest on. When a bank lends out money, is it crying about how it had to give out your down payment for a home, or your boat loan, or some other purchase that you made a loan with them with? Are they upset about giving you that big lump of money? No. Nope. Are they expecting to get it back right away? No. No. In fact, they don't want you to take it and pay it off real quick, because that's their business model. They want to lend out the money and get as much interest as possible. So while we don't want to leave drawdown in long periods out there, we look at, or at least I look at, when I take a loss, or if I go into drawdown, it's just a loan. I know I'm going to get interest on it, because my career isn't going to be framed by the last 5 trades, or the last 5 weeks, or the last 5 months, or the last 5 years. I have a long-term view, and that's the problem with being an infant in this industry. It's too easy for you to want to quit because you don't see past what's happened to you right now, or what happened to you last week, or the last trade, and that last trade, that one singular event, you've made such a monumental experience out of, and it's make it or break it. Every single trade is a make it or break it. I've read 2 people, one on Twitter and one on the comment section of the videos I have, and they're basically saying, yeah, I think I'm packing it in. I can't do this. And if that's true, congratulations. You found where your breaking point is, and you're not willing to go any further into that. And if you know yourself well, Godspeed. But there's a lot of folks that get frustrated, and if you're going to quit, you're not going to post it on the internet. You're not, okay? I believe these individuals that do that, they just want to be encouraged. Like, don't stop me. It's a cry for help. Because honestly, if I would have had that as a medium when I was coming up, I would have went on the internet and said, help. I'm going to quit. Somebody stop me from quitting. I'm going to walk out the door. It's kind of like a relationship when your lady wants to leave. She says, I'm leaving you. And she really doesn't want to leave. She just wants to see what your reaction is going to be as you see her walking towards the door, or grabbing a couple of things of her clothing. If she's going to leave, she ain't telling you. You're going to come home and her stuff is gone. And if you're going to quit this industry, you're not going to talk about it. You just ain't going to be here anymore. So again, roll your sleeves up. Just understand that this is what it's like to be a trader. You're going to be in periods where it's very difficult. And no matter what you do, what you follow, what I taught you, what somebody else taught you, whatever worked in the past, you are going to encounter losing trades, plural. You're going to do it wrong. You're going to have an expectation in the marketplace that isn't going to pan out like you thought. And guess what? That means you may take a monetary loss. And that's a tax on success. You have to pay it. Nobody gets around that. Nobody gets around it. And some of you in here, for whatever reason, think that you're going to stroll right on in here because you're going to be the exception to the rule. And guess what, folks? I'm promising you, you aren't that special. I wasn't that special. Nobody's exempt from it. You all, we all, every single speculator has to pay their toll. And occasionally, guess what? The ferryman's got his bony hand holding out, waiting for you to drop whatever the next sacrifice of your losing trade's going to be. And you have control of how bad that's going to be. You limit it. But you have to do the math and stick to it. Otherwise, if you trade willy-nilly, well, whatever happens, I don't really use a hard stop, but I know when I want to get out. I hate hearing traders say that. That's so disappointing to hear, because really what that is communicating is you really don't have it together. If you don't know where to place a stop loss, you really don't know what you're doing. You don't. So with this model, I've removed that guess, that mystery. Your hard stop needs to be placed, period. If it gets hit, it's done you a favor, period. But if it does you that favor of protecting and limiting risk, it's your job as the trader to listen to the analyst next trade it provides. You'll have to manage the trade with less risk because you have a task now. You have to come out of drawdown. No matter what the drawdown is, you have to come back incrementally. So let's assume you do a 2% risk trade and you lose the full 2%. Your next trade, you could only risk 1%, and it would be basically what I'm showing you here with one contract or one limit order. Not contract, it would be the equivalent of, if you're doing 2%, you would be doing basically 4 micro lots, entering at 37.54 3/4, hypothetical entry on a demo, and your stop loss at 37.45 3/4, 9 points risk across 4 micro lots, $20 per point. Okay, so if you take that full loss at 2%, your next trade, you can only do what's being shown here. 1% risk. And you got to determine, where is your trade defined in terms of points or pips if it's Forex? How much of a stop loss do you need? In this case, we're using this factor here, okay, 9. That's the number of points that's required for the stop for this particular trade. Not every trade is going to require a static 9-point stop. Sometimes you can do a stop, with 5 points. It's hard. I'm not suggesting that you should be trying to do that, but other trades are going to require you to do what? More than 9. Might be 10, might be 12 points. So you have to consider what that's going to do for you in terms of risk management. And eventually, you may get to the point where you lose so much in drawdown that you really can't technically do 1 micro, even if you have the margin to cover it. So that's why it's important for you to be very diligent about managing your risk and controlling drawdown. Don't think, oh, well, I'm going to start off with 1%. And then once you make a trade and it's easy, think, well, I can do 3%. Because if I can do 3% risk and I get a multiple of 5R, I can make 15% one trade. And what if I do that every day? Even better, what if I do that in the morning session and in the afternoon? And if I can do that, why not lose sleep and trade London too? Wow, that's 45% in one day. Good grief, I could probably quit my job next Sunday. I did that kind of stuff, folks. It doesn't work like that. Doesn't work like that at all. So you have to use low threshold objectives and work your way up from that. Your career is not going to be 10 trades and you made it. No. Longevity, controlled risk, impeccable risk management. That's how you get here. That's how you arrive at consistently profitable, and losing trades don't mean anything. Despite anybody watching you, if you do it publicly, a losing trade is nothing but a tax on success. That's it. All right, stop management. And this is going to close the mentorship in terms of the teachings. And past this video, I'll be doing obviously reviews and topical studies when I feel led to do so. But as far as the model itself and the mentorship, okay, for YouTube, this free series I did, this is done. And you'll have everything that you need here. I'm confident in saying that what has been provided to you after this discussion here, you have enough. And obviously the things I taught you on the YouTube channel and other lessons, and maybe other future lessons I might do, they'll just be amplifications and help you refine what this has already given you freely. But stop management, okay, when you place your stop loss down here, when can you and when do I move my stop loss? Well, you have to determine where you're getting in at and where you're trying to get as a target. So that's your range from 37.54 3/4 to 37.80 1/4. So technically 25.5 points. Okay, so what is that? 12 3/4 points, something like that. We'll just round it to 12.5 points. If we see price move 12.5 points above the entry point that you entered at, if it moves 12.5 points, your stop loss can move 25% up. From where? What's 25% of what range? Where your stop loss is and your entry. So split that range in terms of points. If this goes up 12.5 points, which would be 50% of your expected range, then your stop loss can be reduced or trimmed down to 25%. So it's going to give you that little bit of a cookie, that feel-good moment. You trimmed some of the risk. You're not jamming it up above to break even because you're going to worry about it. You're just moving a little bit. Now, when price moves to 75% of the expected targeted range, and it means from your entry to here, if it moves 75% of that, then the stop goes to break even. Period. There's your systematic movement of your stop loss. You're not jamming it to break even. You're not going to be worried about getting stopped out. You're going to be more likely to be watching, does it still keep reaching for your objective? Do down close candles keep supporting price? Does it run below short-term low and run higher with a lot of energy because it took short-term sell stops out? Is it dropping down to a fair value gap and reaccumulating and sending another higher price leg higher? That's what you're watching. That's the things that you're looking for. And as long as it's doing those things collectively or individually, you are on one side. That means you're on the right side of the market, and keep holding for your position to hit target. If you are doing multiple positions, say you're doing competition level leverage, and for me, that's anywhere between the range of 3% to 4.5%, then you're going to be looking to take partials. Okay, and that partial might be, once it goes 20 points in your favor, you have a static number. It always hits 15 or 20. Once it does that, no matter what you're doing, you take something off. Okay, that's something you might want to incorporate in your own trading model as well. But that part is for you to determine. Don't let me give you static rules that are considered, cast in stone, ironclad, can't change it. I hate doing that with my students because it takes away the uniqueness, the individualism that you're bringing as the trader to your own model. So these are just basic foundational points that I think will serve you well, but you're going to obviously evolve and come up with better ways that meet your expectations and also fit your personality. Okay. So I think that's going to be it. And I absolutely want to congratulate all of you that if you've gone through every single one of these videos, if you've done the work and back testing and looking at things and studying, and you're convinced that the pattern's really there, kudos to you. Okay. For those that have not got it yet, my encouragement is for you to keep doing it. And I promise it won't take you long. In fact, if you just started and you just found this channel, I promise you, if you give it 6 months, you'll see things that you never saw before. But at the end of 1 full year, because it might take some of you to do that, you'll have it. You'll understand what you're looking for. Doesn't mean you're going to be trading every single day. It doesn't mean you're going to know the bias every single day. It doesn't mean you're not going to have losing trades. It means that you're going to know what you're doing. And even though you may have short-term hardships with being stopped out or missing moves or reading it wrong, you still will have enough faith in this model because you know it will repeat in the future more times than it fails. And I'm challenging you to determine whether that statement is true or not. Until next time, good luck and good trading.